Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, January 30, 2018. You're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And last night we discussed the distinct possibility that we would see some downside activity either today or even for a few days. That's where the horizontal lines come from on the screen. The first level given was 283.96. We gapped below that level today, so that level didn't necessarily come into play, but the 281.85 certainly did. The market went slightly below that level, but snapped back in the latter part of the morning session and then basically traded back and forth around that level all day long. When you go down to an hourly chart, it becomes more clear and easy to see, and you can see what we've done is basically consolidated all day long right at that 281.85. So we knew that level was going to be important to the market, and it also proved important to the market pretty much all day long. So what we have here is we have a bearish pattern that has developed. If you consider the activity from the other day, we had a down move with the gap opening today, the gap lower today. We went sideways all day. Generally, this is going to finish with another down move, and that down move, if it were to occur, would happen somewhere around 280 even, maybe slightly below, but at this point, I don't necessarily expect much more downside than that. If we get more downside than that, something further is developing, and we'll obviously talk about it here, but on this particular move, if we should see more downside activity, I'm expecting pretty good support around that $280 level. What I want to do now is reiterate some of the important things that are happening this week. This week, there's a lot of activity. The volatility has certainly come back to the market, and I just want to review some of the important events that are coming this week. So we have the State of the Union tonight. Donald Trump, who knows what he's going to say. I don't think that in and of itself is going to have much impact on the market. But tomorrow morning at 8:27 a.m., we do have a lunar eclipse. Those can have a tendency to have a trend change or directional change in the markets. If we were trading up through today, I would suggest that we were likely to see a trend change down after the lunar eclipse occurred tomorrow morning. But since we were down for the last couple of days, I'm not 100% sure on which direction the market's going to go. We can certainly see a lift in the market upward after the lunar eclipse, or we can also see an acceleration to the downside. So I'm not 100% sure. That's a little bit of a wild card. You never know exactly how they're going to impact the markets, but if the market went in a straight line up leading up to that event, or a straight line down for several days leading into that event, then I would feel more comfortable saying that we're going to see a trend change after the lunar eclipse. We also have the FOMC announcement tomorrow afternoon. So the Federal Reserve or the Federal Open Market Committee was meeting today, and they'll conclude their meeting tomorrow, Wednesday afternoon, and then they'll come out with an interest rate announcement that can certainly have an impact not only in the stock market, but the bond market, the currency markets, the precious metals markets, the crude oil market. That can have an impact in markets across the board. So that can also have an impact on volatility following the FOMC announcement. Then we have earnings announcements all week long, but we have some bellwethers occurring on Thursday. We have Apple, we have Google, and we have Amazon. So those are the three big earnings announcements from the stocks that basically everybody owns in one way, shape, or form, whether it's through a 401k, mutual fund, exchange-traded funds, hedge funds. It doesn't matter who it is. Pretty much every institution out there owns those three names. In addition to those, we have a lot of others earnings announcement all week long into next week. We're just going to get buckets full of earnings each and every day, both in the morning and after the closing bell. And then to finish off the week, we have the phony jobs number on Friday. So the employment report is Friday. That can have an impact on markets depending on how the market wants to take whatever the cooked up number is on Friday morning at 8:30 a.m. Eastern Standard Time. So there's a lot of things happening. The market can get very whippy. It can have large swings in both directions. So we just have to be careful in our approach to the markets. In the very short term, I would say that a good rule of thumb is if we were to begin seeing hourly closes during the trading day, or even a daily close, above the high of the first candle of today, 283.29, if we begin to see hourly closes above that level, that's going to be a bullish indication. If we cannot get above that level on an hourly chart closing basis, then there's likely more downside coming in the SPY or the S&P 500 and other markets for that matter. When we look over at the IWM, this is a 60-minute chart. It looks pretty much the same as the S&P or the SPY. We have a bearish pattern developing underneath the 100-period moving average. So right now, the IWM on the hourly chart is beneath the 100, the 20, and the 50-period moving average. So on a short-term basis, somewhat bearish. What we did today on the IWM on the daily chart was come in to the 20-period moving average, which is where we found support. The other area that we found support, so there were two reasons why we found support in this zone today, was this green candle low, which coincided for the most part with the lows today, right in that zone here. So the green candle low came in at 156.55 and the low today was 156.73, just above that green candle low. And it makes sense that we found support right above that green candle and the green candle low, and the 20-period moving average closed above the 20-period moving average today. Now the IWM was about on par in terms of downside activity with the S&P 500. They were both down right around 1%. So the IWM wasn't necessarily leading the market in one direction or the other. The market's pretty much traded in tandem today. Since we did have some downside activity, we will take a look one more time at the VIX, and you can see another explosion. Well, I don't know if I'll call it an explosion, but certainly another lift in volatility, up another almost 7%. So the VIX is here finishing below 15 today, but we got above 15 intraday. You can see what happened out of this bullish pattern that was developing for the last several days. We had an up move, we had a bullish wedge pattern, and then we exploded to the upside. There's probably not that much more upside in the VIX. We could certainly get up to this double top area all the way up here, which comes in at 1728, but now, on a very short-term basis, the VIX is overbought, so I would expect, at least within the next day or two, I would like to see, or I expect to see, some volatility come back out of this market. If we were to hit the downside target that I talked about in the SPY before, that would be the $280 level. If we hit that level, whether it's tomorrow or at some point this week, I would expect the VIX to pop up slightly higher, maybe get up into that 17 range. And if I'm right, and that is in fact at least a short-term bottom for the stock market, that's where the VIX would end up selling off significantly from that level if we got any kind of a rally off that bottom in the SPY. Looking over at the transports, they remain weak. They were actually the leading indicator today on the downside. The transports were down 1 1/3%, another 148, 149 points down in the transports today. And you can see here that it doesn't look like it's done yet. It looks like there is some more downside in the cards for the transports. The transports were certainly the canary in the coal mine this time around. You can see what happened. We had that reversal candle. We talked about it at the time. We had a bearish wedge pattern. That played out, and we continued lower for the next several days. There is a pretty good level of support right around where we are in the transportation average. But if we were to get another flush lower in the transports, this is the spot that would provide a very solid level of support. You have the 50-period moving average sloping up into this area. And this was really another nice breakout point for the transports. And you know what I always say, markets love to come back and check in at former breakout and former breakdown areas. And this area would certainly qualify. I would say that anything in and around the level of 10,700 to 10,650 is really the spot in the transports if we did get another flush lower. Switching over to the gold market, you can see what happened here in the gold market. Where did we go today? The low today was 1337 spot 50. We talked about the fact that the market was going to come back in and check in at the 1338 level. That's precisely what happened. The market touched the 20-period moving average, which is the upsloping trend line, bounced off that area, which also coincided with our 1338 level. And right now we sit at 1341 spot 80. No surprises there, but I would say that with the FOMC announcement coming tomorrow afternoon, Wednesday afternoon, all bets are off in terms of what the markets are going to actually do, if they're going to do anything in response to the FOMC announcement. So whatever that interest rate announcement is and whatever the Fed decides to say with regards to the economy, inflation, deflation, it's not so much what they say, it's how the market reacts to whatever they say. So the reason I say all bets are off is because the markets can certainly get whippy in and around the Fed announcement. The last several announcements, the market has been relatively tame across the board, but you never know. Since we do have a pickup in volatility, we can get a spike higher or lower in all these markets, currencies, precious metals, oil, the stock market, across the board. So what I would say this time around is expect the unexpected. We might not get it, but you certainly have to be on your guard and expect the unexpected. Looking over at crude oil, crude came down with the stock market today about 1% in tandem with the stock market, and you could see where we found support right pretty much on the 20-period moving average. Right above the 20-period moving average, I should say. This is the following day's session. This is the session that begins at 6 p.m., and it is the January 31st session on the 20-period moving average right now. But what we did do is come back right north of the 20-period moving average on Tuesday's session. And all this is working off some of the overbought condition, same in the stock market, same in the crude oil market. Markets are overbought. They're just working off some of the overbought condition, letting some of the air come out of the bubble. That's all it is. This is still in an uptrend. There's no damage to the larger picture, the larger turn uptrend in crude oil. For example, when you look at the weekly chart, there's no damage to the uptrend whatsoever. We're just having a couple of days of downside activity. But in the end, when you pull back the tape and you pull back the curtain, all this has done is basically go sideways for a couple of days in the big scheme of things. No big deal one way or the other. I still think higher prices are likely and higher prices are coming in the crude oil market. Doesn't mean there can't be some more downside activity, but that wouldn't necessarily damage or harm the longer-term uptrend that's already set based on the weekly chart we just looked at. And with that, folks, I'm going to keep it short tonight. I'm going to give it a wrap here. It's everything I wanted to and intended to discuss. We'll be back tomorrow, see what happens in the markets. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.